All right, everybody, my name is Professor Kevin Matthews, and I am the professor for Accounting 351, and of course the graduate equivalent to the course. I'm doing this video because I've had some students who've wanted me to go over some of the problems. Obviously, we don't have time in class, so I'm going to make sure that we go through some of the homework problems and just kind of talk about how I would answer these. It's not necessarily what's officially in the book, as I've come to realize that the book sometimes doesn't always get things correct. So I'll go ahead and I'll kind of talk about it. So obviously this one is for chapter 10. And I'm going to go ahead and I'm going to kind of put this out there. You know, my human resource students are used to seeing me all the time on the video, so this generally isn't too much of a problem, but you know, they're used to me looking down all the time because I've got my computer down here so I can keep my notes going so that I don't lose my place and start rambling off into la la land as I tend to do. But then the second thing is, of course, it glares up and it flashes in my glasses, and I apologize if that starts getting annoying after a while. If you have any questions after you listen to this, you can either go ahead and put comments in the comment box, or you can send me an email, and of course all my students know how to get in touch with me. If you're not in my class and you have questions about some of the stuff that I put in here, please feel free to reach out to me, and you know, by putting comments in the comment box, and then I can get back to you as soon as possible. All right. So one of the first questions we talked about was compare and contrast the basis of property acquired via purchase, conversion from personal to business, rental use, non-taxable, gift, exchange, inheritance. And so the purpose of this problem is that when we're always talking about basis, we tend to automatically think that it's whatever we paid for something, but generally speaking, what ends up happening is that may not necessarily be the case. And so there's definitely some different circumstances where it would take place that there would not be you know, a basis that's based off of the you know, the actual cost of the asset. Of course, purchase is a very common one, and of course it's you know, and that's basically, you know, the historical cost plus all costs to keep the asset, you know, get the asset to its destination in working order. So if we go out and we buy an asset, you know, and spend $100,000 buying the asset, and then we ship the asset to our plant, and we end up paying for that, and then on top of that we end up paying for it to be installed and you know, get it to the point where we can flip the switch and turn it on and actually start making money off of it. All of that is capitalizable cost. And that's from a financial accounting perspective, and generally from a tax perspective. From a tax perspective, there could be some exceptions to the rule. For example, when purchasing a rental real estate, you may get to write some of those things off immediately. You know, a very good example would be you know, property tax. You know, the IRS doesn't want you. I mean, the IRS allows you to take those deductions on Schedule E. Okay, so you have a conversion from personal use. I think I've talked about this in the class. You know, a very good example is when my wife originally had bought a car. It was a 2003 Corolla. Bought it in 2003, and then we didn't actually do this, but we had talked about doing this, where, you know, several years later, when I actually went out and started my own business, we had talked about, hey, why don't we go ahead and see if we want to convert this to a business asset. The depreciation basis would be the lesser fair market value on the date of conversion, or the adjusted basis. So obviously we bought the car. I think she probably paid around $15,000 for it back in 2003. I mean, it was a Corolla. It was baseline. It didn't even have power windows. It did have air conditioning, so that was. I mean, she bought it in Los Angeles, so obviously it would require that. But obviously the fair market value of it would be far less than $15,000. So we would have actually had to get the fair market value at the time, and that would become the adjusted basis as we, or the basis as we would go ahead and, well, no, adjusted basis, I'm sorry, I'm mixing up my terms, for purposes of the business. Okay, non-taxable exchange, you know, so a very good example. If you have a non-taxable exchange, somehow you come into possession of this property through a non-taxable exchange, the carryover basis of the transferor is going to be the basis in the property because there's no recognition of gain or loss. And here's kind of the reason for that, and I'll kind of move quickly through this because I don't want to get too hung up on it. The way that the IRS looks at it is, look, if you're going to have, basis is essentially, pre-tax dollars, so to speak. In other words, there's already been a tax sort of paid on those dollars. So for example, if I make $100,000 in my salary and I go out and I take $25,000 of that and I go buy land, the thought process is that it's already been taxed money, therefore it's not going to be taxed again. And so that's oftentimes where we say, in theory, it's basically taxed once, taxed at the source. Now, obviously, those of you who know corporate tax law very well know that that's not always the case, and we'll get into that when we talk about corporate tax law. So if it's a non-taxable exchange, what's going to end up happening is there's really, the way the IRS is saying is that, hey, we haven't collected tax yet, so we'll let you have that exchange tax-free, but when you sell the property, obviously we're not going to give you a step up in basis or whatever for anything else. And then we get kind of sort of the gift. Gift is pretty much changed. It's basically the same as a non-taxable exchange. Basis is generally carryover basis, and that's because most of them are not taxable. Especially as of now. I mean, because of the new 2017 tax law that went into effect, the exclusion is about $11.2 million, and of course it's going to be adjusted every year for inflation. And so, I mean, unless we're talking like a massively humongous gift, Bill Gates wants to give me, some, 200 acres of some forest land that he's got somewhere out there. That's probably going to be, I don't think he's going to bust his gift limitation for poor old little old me. But, one of the things that they do say is that if gift tax is paid, the basis may be increased by a portion of the gift tax that's paid. And we're not going to get into that because that's not part of what the class is supposed to be about. And finally, the other way that we can receive properties through inheritance. Now, the way the IRS and Congress kind of looks at it is you've suffered a loss, and so what's going to end up happening is they're going to allow you to receive what's called a step up in basis to the fair market value. Now, that's the theory is that it's a step up in basis. We always talk about it being a step up in basis. I've seen it where it was a step down in basis. I remember, we had a client whose mother had passed away in 2000. I think it was 9, and they had bought the property, or she had bought her property in 2005 when the markets were very, very high, and so her basis in the property actually ended up going down. The client's basis in the property ended up going down, and as a result of that, it's not always a step up in basis, but it's generally a change in basis to the fair market value as of date of death. And another reason why Congress likes to do this is, if a piece of land's been held by the family since, say, for example, 1750, records just don't exist. And so that's not really fair to the taxpayer that they have to go back to, something that was 1750, and especially if, they paid 4 shillings for something and they're like, okay, well, what's a shilling and all that. There's a lot of reasons why this just actually makes a lot of sense, especially with inheritance. So, and it's fair market value as of the date of death, or you can do an alternative valuation of 6 months later, but the estate has to make the election, and in order to do that, you have to file a 706. So the next question that we talked about was what are the 2 depreciation conventions that apply to tangible personal property under makers. And this kind of gets into the half year, mid-quarter, mid-month conventions that we were talking about in class. And under regular tax, it is half year and the mid-quarter convention. And essentially what the reason why, generally it's going to be half year for all personal property assets that are placed in. And when we talk about personal property, we're talking, cars, trucks, tables, desks, chairs, computers, little things, not real property, essentially. And one of the reasons why it's half years because the Congress and the IRS, it's not really important at any time during the year when you put it in, and also there's a little bit of, we don't want people to play games with the way that it works. So we don't want to have a situation where you are waiting 1 to 2 months to purchase something, or you want to purchase it all in the beginning of the year because you want maximum depreciation value. And to be honest with you, I can't imagine why people would do that, but I don't think that the benefit is quite there, so to speak. But the half-year convention does actually help a lot with auditing, I would imagine, because if it showed up anytime during the year 2017, it's half a year. Now, one exception from that is the mid-quarter convention, and the mid-quarter convention was put into for Congress because one of the concerns that you could have is, okay, so I could buy a whole bunch of equipment in December and be able to write off one half of the depreciation that would be allowed, and so or not even just December but also November and October, and so the mid-quarter convention kind of prevents some motivations to do that. And I think it makes a lot of sense. We don't want the situation where and one of the things that Congress really always loves talking about is they don't want people fudging. They don't want people doing things simply for tax avoidance. Now, again, that's kind of what what we get paid for as accountants, of course, is we try to help our clients make tax sensible decisions, and so we're going to talk. We're not going to belittle. We're going to do what's in the best interest of our client, but of course, we would then need to do what's in the best interest of the client. Okay, so I've got about 8 minutes left, and so I want to really talk about, there's this big problem, and I'm not going to talk about any of the forms that were used in the big problem, because I'm going to do that in a separate video. And so sort of talking a little bit about some of those things that end up happening with that. But basically, this is Carnegie Enterprises, calendar year manufactured, based in College Station, Texas. And they bought some assets in 2017, and they bought some assets in 2018. And one of the things that we noticed when we were going over these problems is that the answer key actually got this one wrong. And so this is actually kind of one of those reasons why I'm actually very glad that we're not going to post the answers. But essentially what would happen is, and this is kind of what you want to do in theory, and I'll let you guys kind of review this, how you did your answers yourself. You'd want to take the 179 expense against the biggest asset first. In 2017, the 179 limitation was $510,000, and so you want to run that against the biggest machine for the 2017 tax year. And so what would end up happening is, and this is where the book got the problem a little wrong, is that they used the 2018 numbers, unfortunately, and accidentally. And as a result of which, it had a cascading effect, and it really made a lot of other errors that took place. So again, the way I would do it is I would probably take the 179 expense against the big machine first, and then they talked about in the first part of the problem, they didn't want you to be doing bonus depreciation, and so it would basically reduce your for the big machine, it would take it from 1.56 down to 1.05 as your maker's basis, and then you would continue to depreciate after that using the tables as they had it. And here's something else, I'll talk about this later on, but if we have the test will not ask you to kind of figure out what the depreciation maker's year life is going to be, simply because of the fact that that's always subject to debate sometimes, whether it's a 5-year property, 7-year property. There's been some times where I've had some arguments with some people about it. So if I'm going to put it on a test, I'm not going to force you guys to sit there and memorize what machinery's life is and things of that nature, especially because machinery is such a generic term. and I just think it's so subject to depreciation, it's basically subject to interpretation. So what they're saying here basically, so for the next part of the problem, once you take it out to, let's see, so I'm trying to see where I'm at. I'm kind of lost here. So compute the 2019, compute 2018 and 17, but now assume that they would take bonus depreciations for part C. And for part C, obviously you're going to take the 179. And then what ends up happening is you would, let me see here, because they've got it kind of convoluted. Yeah, so that's kind of weird. Yeah, so they're basically saying, yeah, see, and that's the thing. That's why I couldn't use these answers when we were kind of going through this. But essentially, you're going to take the 179 against the largest machine, like they said before, and then you're going to take bonus off of all of the assets based off of 50% of their maker's basis. And generally, that's not going to happen too often. Where you're going to have an asset that has both 179 and bonus. But they have this for this problem. I'll tell you what, I've used most of my clients that I've worked with. Their entire asset write-off is probably around $2,000-$3,000 because they're a small business, or maybe when they first got into something they decided $75,000, just based off something that they borrowed off of. So it's an interesting setup and everything. So again, I'm not going to talk about the forms, and so what I will do is then we'll move on to the next stop. Thank you. Oh, by the way, so before I sign off, like I said, if you have any questions, put comments in the box. For secondary, if you're a student of mine, you can also reach out to me. Reach out to me at my business address, and you guys will know what that is. So feel free at any time. Thank you very much.